Good afternoon. I tried hard in the copy nearby to be lucid. 2 or 3 times a year I try to drop the smart-ass humor and the incomprehensible technical references and just write something straight. And some of you may have thought it's an April Fool's joke on my part, but nope, I was really trying hard. The Fed has not raised interest rates since 2006. That's a long time ago. And just to write about it and think about it, I can imagine how they feel and how uncertain they feel about what to do and how to do it, but they've got to do it. They feel, above all other things, Fed officials think they need to get off zero. They need to lift off. Zero as an overnight cost of money is so artificial, such an emergency measure, that the sooner we can bring that to an end, the better. Now, what's throwing my part of the world into chaos, the bond market, the mortgage market, long-term interest rates, is historically, every time the Fed has begun to raise interest rates, or for that matter, cut them, it continues in a straight line until the economy shifts gears. That is, every tightening cycle has ultimately, no matter how many years it took, resulted in a recession. And this, there isn't anything going on in the U.S. economy that indicates the normal, rapid, upward spiraling, self-reinforcing kind of economy that the Fed needs ultimately to intercept and just shut it down for a while, let unemployment rise to head off an inflation problem. This has to do with normalizing. And the Fed hasn't done very well talking about normal. Normal from roughly 2000 back to World War II led to an overnight cost of money around 4. Today, 4% would stop the economy in its tracks. It would lead to mortgage rates that might be 6 or 7%. And we don't have a housing recovery yet. The Fed next Wednesday, there's a 2-day meeting, Tuesday and Wednesday. The meeting will break at noontime East Coast time, Wednesday the 18th of March. And as a companion to Yellen's press conference after the meeting will come a 1-page statement, but also will come quarterly data on the Fed's own internal expectations. And one of them is a scattergram of dots of where Fed officials think interest rates, the cost of money, will be in the future. And the mortgage rates haven't risen much from the low in February. There's some wondering about why we're as low as we are to begin with. But we're going to get some inference next week about the slope of Fed tightening ahead. And I hope that they will acknowledge that although they need to get off zero, and they need to get up towards 1, 1.5, 2, depending on incoming data, the Fed at the moment is at grave risk that its saber rattling is already unsettling and even destabilizing markets. We see it globally. It's why the dollar has departed all the other currencies on the planet. Every other central bank is easing while the Fed is tightening. And it's a delicate moment. I think the world of Janet Yellen. And I'm not so much anxious about next week as I am curious about how she plays this. See you next Friday.